Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lumen Technologies stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen Technologies is a telecommunications company. It is one of the largest providers to global enterprise customers. Its communication services include local and long-distance voice, broadband, Ethernet, video network. It has clients in more than 60 countries. In September of 2020, CenturyLink announced that it had changed its name to Lumen Technologies. Also, they changed the stock ticker from CTL to LUMN. The main reason the company changed its name to Lumen was to try to move away from CenturyLink's past struggles. CenturyLink will continue to be the customer-facing brand for traditional copper-based services. A copper-based internet connection is the standard connection type that has been used for over 100 years. It will also offer fiber-based products and services under the brand Quantum Fiber. CenturyLink merged with Level 3 in 2016 to capitalize on the more advanced fiber technology. Lumen has laid down 450,000 miles of fiber network, as well as 38,000 miles of subsea fiber. The company received a large amount of tax subsidies by doing this. It also laid down over 900,000 miles of copper. The company is headquartered in Monroe, Louisiana, and was founded in 1930. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 10 billion market cap. They're trading at $10 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they generate lots of free cash flow, $3 to $4 billion a year. Free cash flow is the cash flow that's remaining after paying all your day-to-day expenses. So it's a cash that's left over for you, the investor. That's why they pay such a nice dividend. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's positive in 2021, negative in the prior years. Revenue is a sales for the company, and that doesn't look so great. It's decreasing each year from 23 billion to 20 billion. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is their big cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that's decreasing from 12.6 billion to 11.2 billion. Below that is their operating expenses, and they've done a good job at lowering their operating expenses. That was only 6.9 billion in 2021. So they did have their highest operating income that year. Below that is the interest they pay in their debt, which is getting better each year. It was 2.2 billion in 2018, now it's 1.5 billion. Then you have other income and expenses, and this is why they have negative net income in 2018, 19, and 20, is they pass through these large goodwill impairments. When you acquire a company for more than it's worth, you have to book goodwill onto your balance sheet. And then each year you test for goodwill impairment. So if you feel the value of that acquisition is lower than what you paid for it, you would reduce the value of goodwill in your balance sheet and then pass through a loss onto your income statement. Even if the acquisition happened 10 years ago, you pass through the loss in this current period. It's best to just focus on operating income when you look at the income statement, because these large negatives can really skew the net income number. They did have positive net income in 2021 because they didn't pass through any impairments that year. This is the company's income statement directly from their financial reporting. This is 2020, 2021, the fourth quarter of 2020 and the fourth quarter of 2021. Their revenue decreased from 5.1 billion to 4.8 billion. Their enterprise revenue is their bread and butter. That was 2.6 billion. 1 billion from international, 900 million from large enterprises, and 665 million from mid-market enterprises. Their wholesale business was 890 million. 3.5 billion of their revenue was from businesses, 1.4 billion was from consumers. and their revenue has decreased in every single category. Here's a breakdown of their consumer revenue. $700 million from broadband, $39 million from SBG broadband, $500 million from voice, and $122 million from Connected America Fund. This is an initiative to get voice and broadband to areas that it's not available. And one of the few positive things is their fiber subscribers are growing. They have 803,000, that's up 128,000 year over year. And they have 2.8 million customers that are fiber enabled, that's up 400,000. They penetrate 29% of the fiber market, that's up 1%. The average customer spends $58. Their cost of revenue is $2.1 billion. Revenue minus cost of revenue gives you your gross profit. So their gross profit is $2.8 billion. When you divide that by their revenue of $4.8 billion, that gives them a gross margin of 57%, which is the average of their industry. But their net margins are 10%, which is a lot better than average and also the median. They are doing a really good job at managing expenses. SG&A is down $140 million. Depreciation and amortization is also lower. And they didn't pass through any impairments in 2021, so they have positive operating income. So in the fourth quarter of 2021, they had net income of $500 million. Last year was negative $2.3 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate lots of cash flow, $6.5 billion in 2021. That's a lot of cash to work with. And they spend about $3 to $4 billion a year in CapEx. Every time they build out their infrastructure and lay down cables, that's part of CapEx. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow. That's why they pay a really high dividend. And they've been paying down a lot of debt as well. Every year they pay down debt. $2 billion, $4.5 billion, $7 billion, $3.5 billion. They do add debt, but a lot less than they've been paying down. That's another way to give back to shareholders, because when you pay down debt, it decreases the interest payments you pay on that debt, which means more money flows to the bottom line. This is the operating cash flow section from their statement of cash flows. And this is directly from their financial reporting. The way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. That goodwill impairment is a non-cash item, so we add it back. You can see how much the net income differs. Positive $2 billion, negative $1.2 billion. But their operating cash flow is almost identical. That's why I like to focus on operating cash flow. That's a much better indicator of how the company's doing than net income. The way to run a business is on cash, not on accounting tricks. This is their revenue and operating cash flow since 2015. They did have a good pop in revenue from 2017 to 2018, but since then it's been going down little by little. But they have really strong operating cash flow each year. And the forecast is for their revenue to continue sliding, and their operating cash flow to decline a little bit, but not too much. Pretty much it's going to be steady. This is their investing and financing sections on a statement of cash flows. This is 2020, this is 2021. And they spent a lot in CapEx, $3.7 billion last year, $2.9 billion this year. In their financing section, they took on $1.9 billion of debt. They paid down $3.6 billion. They paid out over $1 billion of dividends, and they bought back $1 billion of common stock. That's another way to reward shareholders, is to buy back stock. Because when a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. So in their financing section, they had a cash outflow of $3.8 billion. Last year was a cash outflow of $4.3 billion. This is the equity section on that 12/31 balance sheet. They have $12 billion of equity. They raised $19 billion from selling their business, and they lost $6 billion from running their business. Accumulated deficit is a sum of all the company's prior net incomes minus the sum of the dividends they paid out. Let's look at the capital structure. $12 billion of equity, $29 billion of debt. They're 29% equity, 71% debt. So they're pretty leveraged. This chart shows their capital structure since 2015. This red line is their debt. The blue line is the equity, and the green line is the cash. Ideally, you'd want to see the blue line above the red line, but that's not the case with this company. They have more debt every year than they have equity. The largest difference between the two lines was in 2019. They have closed that gap a little bit the next 2 years. And I gave them a weighted average cost of capital of 8%. That's the highest whack on Finbox. I tried to make the model as conservative as possible, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $21 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $24 billion. We divide that by 1 billion shares. And we get a calculated stock price of $23. They're trading at $10, so they're trading at a 57% discount. It's a buy according to the model. Their revenue is projected to decrease 7.4%, so I decrease it 7.4% for the next few years. That's how I got their future revenue estimate. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by these 4 revenue numbers. And that comes out to 15%, so I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. And usually for my terminal value, I have the company growing 2.5% indefinitely. I did the opposite with this company. I had them decreasing 2.5% indefinitely. Even taking all these precautions and with a higher whack, the stock still seems really undervalued. Simply, Wall Street values the company at $14. They're saying it's 31% undervalued. 4 analysts price this stock and the average price target is $10. The low is 8, the high is 11. This is where the stock has been trading the last 5 years. It was over $20 for a while. Then it took a big hit in 2019. And it's really struggled to break through $15. There was a short squeeze on this day, lots of buying activity. But a short squeeze is usually a temporary thing. You can see the stock price came right back down. I think people are just scared to buy the stock because it keeps declining in revenue. But I think it should plateau at some point. And I could see them being an acquisition target, because they are bringing in positive cash flow and they're trading at a pretty big discount. When a company is acquired, their stock price generally goes up a lot, sometimes 50% right away. The company did cut their dividend in 2019 from 54 cents to 25 cents. Since then, they kept it steady, but that's why their dividend yield is so high, over 10%, because their stock price has come down and they kept their dividend steady at 25 cents. To calculate the yield, you can multiply the last dividend payment by 4. 4 times 25 cents is $1. Then take that dollar and divide by the stock price. And that's only 28% of their free cash flow. So they have plenty of cash remaining to grow the business, to buy back stock, or to pay down debt. The company mentioned in their most recent presentation they're going to maintain that $1 per share dividend. And also, they seem to have excess cash left over, so they're probably going to buy back stock as well. This is their dividend yield since 2011. It peaked at about 13%. Even now, it's around 10%. They've always paid a really nice dividend. So even though a lot of people don't buy the stock and force the price lower, the people who do own the stock receive this really sweet dividend payment. Their beta is close to 1, so the stock moves with the market. It's gone down 17% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 10, the high is 15, and the stock is trading below its 50-day and 200-day moving average. Since their dividend is so attractive, nearly 28 million shares have been traded on average each day the past 10 days. So it's a really popular stock, lots of trading activity. Of the 1 billion shares outstanding, 937 million are on float. 80% are held by institutions and 10% of the shares on float are shorted. Their employee count was close to 50,000 in 2018. Now it's below 40,000 at 37,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $5,600 today. That's a 44% loss. But if you did invest $10,000 10 years ago, you don't have to sell. You could just still keep receiving your dividend payment, and when the stock goes back up, then you can sell if you want. Here's an overview of the insider buying and selling in the past year. So there's been a lot more selling than buying. Only 5,000 shares have been bought. About 25 million shares have been sold. Here's a list of the insider buying and selling, the date, the company or person, the shares, and the price. This private company owned 100 million shares. They did sell off 25% of their stake, but they still own 75 million shares. 71% of the shares are held by institutions, 20% by the general public, 7% by venture capital and private equity firms, and 1% by insiders. The biggest shareholder is Vanguard at 11%. They own 113 million shares valued at $1.1 billion. Then BlackRock, then Temasek, the company we were talking about earlier, Southeastern Asset Management, and State Street. Let's look at their financial ratios. Your eyes are not deceiving you. These numbers are correct. They have a PE of 5.0. That's stock price over earnings per share. That's one of the best PE ratios I've ever seen, especially with a company that's generating so much cash flow. Their price to sales is 0.5. That means their revenue is double their market cap, and their price to book is below 1 at 0.9. Just looking at these ratios, it implies you're taking almost no risk when investing in this company. Let's look at their non-current assets. 21 billion of PP&E, 16 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 7 billion of other intangibles. This could include computer software, licenses, trademarks, and 2.6 billion of other. Their return on invested capital is 8.4%. They do have a lot of debt, but they could cover the interest payments on their debt almost 3 times. A way to inflate your ROE is to add a lot of debt, and that's why they have such a high ROE at 17%. They have a good current ratio of 1.6. That's current assets over current liabilities. Let's look at their current assets. 350 million of cash, 1.5 billion of accounts receivables, 8.8 billion of assets held for sale. These are assets the company plans to sell within the next 12 months. When an asset is held for sale, it's not depreciated, and 800 million of other. Let's look at their current liabilities. 1.6 billion of debt, 758 million of accounts payable. They have a bunch of items and accrued expenses. These are expenses the company has incurred but has not paid it yet. 860 million of salary and benefits, 228 million of taxes, 385 million of operating leases, 278 million of interest, and 230 million of other. And they have 2.3 billion of liabilities held for sale. This is the debt that's attached to the assets that are held for sale. And 617 million of deferred revenue. Deferred revenue is when a company prepays for a product or service before it's delivered. They generated 3.6 billion of free cash flow in 2021. They have over 4 billion of working capital, and they pay out 1 billion of dividend payments. So the company's really well funded. They have $7 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 62 companies in the same industry as Lumen. If Lumen has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they spend more on CapEx than the average company. They're much more leveraged than the average company. They pay a really high dividend. They generate lots of free cash flow. They generate more than T-Mobile, and look how big T-Mobile is. They have the 17th highest market cap of the 62 companies. Look at their price multiples. These are amazing numbers. You rarely see numbers this good. They bring in more revenue than the average company. Their revenue is declining, which is a big issue with this company, and they have a good ROA and ROE. So to summarize, I have them trading at a 57% discount, and this does appear to be a value trap, but I just do not see that much downside. The stock is so low, and they generate so much free cash flow. The worst thing that happens is the stock goes down a little, but you receive your 10% dividend payment. And there's not that much downside. There's much more upside potential than downside. It seems like a great opportunity to pick up a stock at a cheap price. But there's lots of people out there who would never buy a stock with declining revenue. But just because revenue is declining doesn't mean it's a bad thing. You still could get a good value. If a company is increasing their revenue 20% a year, but they're losing money, how is that a good thing? Yet, some people still buy that stock and drive the price a lot higher. I rank their free cash flows 8 out of 10, their revenue 5 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.